Hi, this is Chuck Hughes. In today's video, I'd like to take a look at one of my favorite fundamental indicators, and that's growth in stockholders' equity. When you purchase a stock, you become a partial owner of the company, and you actually own a percentage of the company. And the value of your percentage of ownership is known as stockholders' equity. And stockholders' equity is essentially the net worth of a company, and it's calculated by subtracting the debt of a company from its assets. And if you were to break up a company, the stockholders' equity would equate to the breakup or liquidated value of a company after all debt is paid. When a company produces earnings and is able to retain those earnings, it increases its stockholders' equity. And retained earnings are normally the largest component of stockholders' equity or net worth. So when a company is able to grow its stockholders' equity, it creates economic value for its shareholders, and it makes a company's stock more valuable. As the stockholders' equity or net worth of the company grows, the company can actually increase its production or services. For example, banks can increase their loans, insurance companies can write more policies. So this increase in production or services can in turn create more income for the company. So a company that's growing its stockholders' equity is creating real wealth. Companies that produce and retain earnings enable stocks to provide the best returns compared to all other types of investments, including commodities, precious metals, fixed income, or real estate. And the increase in stockholders' equity of a company has always allowed stock investors to enjoy the highest investment returns. And as long as companies continue to produce and retain earnings, stock investing will always provide superior returns compared to all other types of investing. So in my actual trading experience and historical research, I discovered that there's a strong correlation between the growth of a company's stockholders' equity and the price appreciation of its stock. Historically, the market price of a stock normally follows the growth of a company's stockholders' equity. So we want to focus on companies that are growing their stockholders' equity at a fast rate. And you can download stockholders' equity data for stocks on Yahoo Finance or Google Finance. But I found a great website, ycharts.com, that plots the growth in stockholders' equity with the stock price of a stock. And I'm displaying the price chart for Apple, and it's plotted against the stockholders' equity. So we can see from this chart that the stockholders' equity is growing at a very fast rate, and there's a corresponding price appreciation for Apple stock. So this would be a good example of a company that's growing its stockholders' equity at a very fast rate, a very successful company. Here's another example of a company with very strong stockholders' equity. This price chart is for Baidu, the Chinese internet company. So strong growth in stockholders' equity is a good indication of a very healthy company and one that is creating real wealth for its shareholders. So growth in stockholders' equity is a great fundamental indicator that allows us to focus on companies with good profit potential. I own Apple and Baidu stock, and I'm displaying two of my brokerage account profit loss reports that show real-time profit results for my Apple and Baidu positions, along with some ETFs that I own in the portfolio. Here's a snapshot of my second brokerage account profit loss report, And between the two accounts, I have total profits of $163,355 for my Apple and Baidu positions. This is Chuck Hughes. I want to thank you for listening, and I wish you the best in investing success.